And next up, we have Barry Dawes. He is executive chairman of Place Securities. They are a boutique stockbroking firm. Barry has been known by some to be very bullish on the gold sector, but he also looks at it in a bigger picture. So what we're talking about here today is gold, the metal of prosperity, Barry's views on what's going on in the world. And I think it's going to be very, very, very interesting talk today. Barry, thanks so much for joining me on the Virtual Gold Conference. Ladies and gentlemen, sit back and really take some notes here. There's a lot of information. Barry, over to you.
Hi, Kerry. Thanks for the opportunity. Yes, it's an interesting time. The gold price has been doing strange things, and we're always asking, why hasn't the gold price moved much higher, and what are the factors driving it? So anyway, we're trying to look at it this way and think about other possibilities of how you should view gold. And my conclusion really is that because of the end user and the end user demand being mainly the global consumer, gold is really the metal of prosperity. So let's think of some of the issues that we can to talk about. First of all, we've got to try and reconcile this issue of gold bulls and gold bugs. Gold bugs think that we're going to see hyperinflation and the gold price is the last man standing, and we're going to have economic collapse and all that sort of stuff, which is fine. It might happen. I happen to think it won't, and I happen to think that being a gold bull rather than a gold bug gives you a much better understanding of what's really happening in the world. Usual disclaimers when we start talking about stocks, but the key feature for gold is demand for jewelry, bars and coins. So that's really, it's a consumer demand, more direct, I think, than any other metal or commodity. So it's something that we need to understand, and what's really been driving it is the rising living standards in Asia. We all know about China and India and everywhere else, and also the Middle East. But while that's been growing, that's been taking all the gold production and underpinning the rise. What we've also got, though, is the American economy, and it's a real renaissance underway there. And I don't know if the marketplace thinks like this at all, but the US now is a number 3 consumer of gold jewelry, and that's something that it hasn't been for quite some time. So that's an important driver. I just see increasing prosperity in the United States. There are many things happening in the world at the moment, a lot of changes. I like the concept of the reawakening, and I think that the reawakening in 2022 will be quite massive, and it will really unleash energy that has been diverted elsewhere, and will revitalize, I think, consumer and population confidence. It's really important. Now, sure, we've got all the sovereign debt and inflation and debasement of currencies and all those things that are there, and gold has a very important role to play, particularly for people who, let's say in Turkey, in the past year. So that is important. But underlying all this is this growing prosperity of 1.4 billion people in China, 1.4 billion people in India, and over 1 billion people in Africa. So gold is in a long-term bull market. We saw the first leg from 2000 to 2011, and we saw a long correction. The second leg is underway, and we saw the first part of that with a correction, and the second leg, part 2, is underway. And we've been through the past 6 months with price suppression, which has affected people's confidence, and their feelings for whether gold is going to go higher or go lower in 2022. But I think we're just about there. I think people might be surprised how strong gold will be in 2022 for all sorts of reasons. But the underlying thing is that the demand for gold by the consumer is very strong. So the long-term view, as we mentioned, here's the first leg from 2000 or 2001, depending whether you're in London or New York, and and it was by about 50 cents. So whether it's $246.50 or $247, anyway, take your pick. But we had a bull market where the gold price almost it went from 246 to 2089. This period here is really interesting post the GFC. This is really driven not so much by prosperity, but by monetary expansion. And then we had a long period of correction while the underlying demand caught up with the monetary expansion. So here's our next leg that's clearly been underway. We're finishing this correction. We've broken this downtrend. We've had price suppression for 6 months, but now I think we're heading higher as we break through this, and we can see it in the shorter term where we've got this bulge, as I call it, at around about 1875. But once we break that, we're going to go much higher. So the gold price looks pretty robust to me, and in the short term, it looks very strong. So a lot of the discussion is always about the US dollar as the reserve currency, and thinking, is the US dollar now in a bear market, or is it still in a bull market? We've got all sorts of issues. People focus on the US debt of 30 trillion and how much the Fed has funded that, and who else has been funding it, and what other unfunded liabilities are out there. So they're real concerns, and we've certainly got really corrupt bureaucries right around the world, and in the United States it's bad, in Europe, and then the UN and the World Health Organization, those sorts of organizations, the IPCC, these are absolutely corrupt. So we're finding that this is being unwound. We've got a reawakening underway throughout the world. I think the COVID pandemic, the way that's been handled by the bureaucracies and politicians, people are very unhappy about that, particularly when the evidence is coming out that the vaccines and what they are doing is just wrong. The mandates are wrong. So you Canadian truckers there at Ottawa, the world's watching you, and I think we're going to see some regime changes. And I think Canada might be the first one, but there's going to be quite a few all around the world. So then we can look at we need to come back at the American economy. And as a commodity analyst for many years, we always used to just essentially ignore the United States. It might be 25 or 30% of copper consumption or zinc consumption or one of those sorts of things, but it never did anything. It was, if anything, we're seeing efficiencies, reducing demand for commodities, and all the action was initially in ASEAN and then in China and now India. So the focus is elsewhere. But the US is undergoing quite an extraordinary renaissance in my view, and I see it as a powerhouse. Certainly not a basket case. So the impact or the factors that impact currencies are clearly interest rates at the margin, but they're bigger issues. And so when we start looking at the US, I see this reawakening underway. I follow the electoral fraud issue very closely, and I think we're going to see some big changes coming about as that comes through over the next few months. And I also think with what's happening in big tech with Facebook, Twitter, Google, and where these things have been political organizations and not commercial businesses, they're paying for that. So we can see.
I note that you say there, though, Barry, that interest rates are going to be rising. Do you really think that that's a strong possibility? And do you think it will have much of an impact?
Oh, look, it's going to happen. It is happening. You've got to look at the bond market. That's really telling you what's happening. We really need 3 or 4% on a 10-year treasury and more on a 30-year to reflect the risk of having bureaucrats run these things. So the bond market's had a 40-year bull market, and it's terribly mispriced. It's just overpriced. So I can see, rather than a collapse in the bond market, which depends how you look at it. When you've got long maturity and low coupons, the impact on the price of the bond is catastrophic. So the bond prices will fall very sharply, but I think they'll stabilise at probably 3 or 4%, which is sort of at least double of what we've got at the moment, and that's is pretty horrible in terms of bond prices. So they will be rising. Real interest rates are so low at the moment, but I just think that by the end of 22 and then into 2023, we'll get things stabilising, and then I think just market forces of a freed up global economy will actually increase supply, get rid of a lot of the supply problems. Energy is a bit different. We've got a real supply problem with hydrocarbons, and green policies are just stupid. And ESG policies are equally so. They'll just cause unnecessary hardship by having higher hydrocarbon prices. So we can talk about interest rates rising in the States, and then we can look at what's happening in some of the other major economies. And clearly smaller currencies, like the Turkish lira and other small economies, they're stressed. So if we look at the US dollar, we've got a broad index that we can follow. That's still in a bull market, and it's interesting when we go away from that and look at it in more a narrow sense. We're going to say, well, if we've got a weak US dollar, what's it going to be weak against? Now, here's a long-term euro that I like this from the chart store. When I look at that euro is going to break down, and when we think about the energy policies underway in Germany and also in Britain, doing away with nuclear power, shutting down all their coal-fired power stations and relying on wind and solar. It's just a recipe for absolute disaster, and we've seen higher energy prices. So I can't see the euro rallying against a US dollar, and so I see that euro breaking down. If we look at the pound, it just looks pretty horrible to me. Next time it comes down, it'll go back to parity against the US dollar over the next few years. But we've already seen the yen break a 50-year uptrend against the US dollar, and I think we're going to see the yen much lower. We tend to think of the yen in terms of how many yen per US dollar. So we're about 115 at the moment. I see that going to 135. So it just means we've got a strong dollar. When we look at central bank issues, Holger Schapitz puts together some great stuff. But here we've got the Bank of Japan with its central bank holding 135% of GDP as bonds. The European Central Bank's 82%, but the US Fed is only 37% of US GDP. So If you're worried about the US, you've got to be worried about these other currencies even more, and that's what I'm seeing. So the US dollar does look to me as if it's made a fairly important reversal down here, and it's on its way higher. You've got to keep in mind here we're talking the euro makes up 57% of this index, so it's really whatever the euro does. The pound and the yen are around about 12-13% each, so they don't matter anywhere near as much as the euro. And this says to me that we're still looking pretty good for the US dollar. Now, when we start talking about gold and the bond markets and currencies, bonds are currencies with a coupon. We're going to see a weaker bond market, but now I think we've got a major break in gold versus bonds. For bond prices falling and gold price rising. Gold's rising against most asset classes, but we've got a relatively strong US dollar, so people are a bit focused on that. The gold price in other currencies is rising much faster than it is in.
Sorry to interrupt you, Barry. Is that because those currencies are weakening, that the gold price is strengthening against those currencies? Because it's even doing that with the Aussie dollar.
Yeah, look, you have the gold price is rising faster in other currencies than it is rising in US dollars at the moment.
Yeah,
and that applies for almost all currencies. The Chinese yuan has been relatively strong, but I'm not sure how long that's going to stay. I just don't know. This too difficult to follow China for me from that point of view.
Yeah.
So then we come back to what's happening in gold, what drives it. So gold demand is mostly consumer investments, whether it's bars and coins or whether it's jewelry. And we've got three big players, basically China, India, then the US, plus the Middle East. Everything else is small compared to those four players. But what's happening in jewelry, which is the thing that really twigged my interest in all this. In 2019, the US had very strong jewelry demand, and obviously, well, it weakened in 2020, but in 2021 it was up very strongly, and in the fourth quarter of 2021 it was very strong. So this to me is basically saying that the US is regaining wealth. So now this is interesting. This is global GDP changes, total GDP from data from the IMF, and this is gold consumption. And gold consumption is defined as bar plus coins plus jewelry, and you can see that everything turned down in 2020 with the virus shutdowns, but the response out of 2020 in gold consumption is really very strong. And if we have a look at this on a quarterly basis, here we have gone to the highest level since 2013 at an annualized rate. And so what I'm seeing all this period here, gold price was relatively flat, and this is the average gold price, not the highs and lows, and this is what quarterly annualized consumer gold demand was. So this up here, sure, there's a bit of makeup for the decline here, but I think this is going to continue, and I think it's a very interesting thing to focus on.
Just go back to that previous slide for a second, Barry. There was a big spike back in 2012, 2013. I'm just curious, do you know what that was? That was
Yeah, look, that was China. It was just a massive growth in China, and I think that was sort of government policy to get people to go and buy as much gold as they could. And I I think that there was this all the massive stimulus that took place in China immediately after the GFC, and I think that that's the best way I can understand that, and we can see it here.
Oh yeah, there you go.
Okay, so it was just massive growth here. So we come back here. China and India both had very big numbers in 2021, and here in the US. I mean, look at these numbers here for jewelry in the US. It's bigger than it was in 2010. So, to me, that's a very critical indicator. Now, the other thing that we've got in the US, which makes it really fascinating, is the US a basket case or a powerhouse? This stuff from Ed Yardeni I'd not seen before, but I was just amazed to see how their assets and net worth. I mean, here we've got net worth of 140 trillion, which means that 30 trillion that we've got for US debt is not so bad. And when you consider that the liabilities of the household sector is only 18 trillion, and it's almost as low as it was in 2006. So the US households are just in really remarkable shape. And when we see some other data from this data series, and if you have a look at the amount of cash and deposits that exist there in America, it's about 17 trillion. So it's equal to GDP. And there's, funnily enough, US households only own $3.8 trillion of fixed income securities, which is a staggering thing. I would have thought it was much more. And when you take that 30 trillion, if the US consumer, so to speak, households have not been buying US bonds because they're too expensive, if they got 3 or 4% yield, I think they could move some of that cash into bonds, and the debt would not be the issue that it was. Now, deriving all this is the stock market. We've had a bit of volatility in recent times, but we're still looking very nice in these channels, just coming back to support here. Obviously, the big tech companies have had big thumps, and they deserve them. If we look at NASDAQ versus the S&P, it's grossly overpriced. And that was a real warning flag last year that the tech sector was heading lower. All the news might be on the big mega stocks. When you've got stocks that are capitalized over $2 trillion, much bigger than the Australian economy, and it's very hard to justify those sorts of ratings. But if you look at the S&P or the Dow, net of those big mega companies, things aren't too extended at all, and earnings have been really very robust in most sectors in the US. And
Harry, when people talk about the global stock markets potentially heading for a bit of a downfall, are you suggesting there could be certain sectors that will come off, but not the market as a whole?
Oh, absolutely, yeah. And I mean, you only have to look at energy. The energy sector against the S&P 500 is at a massive discount, historic. The US has been such an energy powerhouse. It makes up about 20% of their GDP. The current administration's policies towards the energy sector have just been stupid. Well, as I certainly of the opinion that the electoral fraud that took place in 2020 it will be unwound. I think we'll see a lot in the next 3 to 6 months. I think there will be a regime change there. And so the policy changes in the United States will be quite massive. So the energy sector looks pretty exciting to me. But the retail sales in the US have just been extraordinary. The cash levels are high. The housing sector is, I think, going to be the real powerhouse for the US for the next 3 to 5 years. So lots of other sectors are going to do quite well. The biotech outside big pharma is still a very, very exciting sector. So just internal rotation, but the long term it just looks good. And globally, it looks good. I look at emerging markets, and they've just about come back to their uptrends. We've got some really interesting things like Taiwan is at a near all-time high. Shanghai has broken a short-term uptrend, but I don't know if there's much downside there. The Nikkei in Japan looks quite robust. So when you look at stock markets around the world, they're holding up reasonably well, and it's as I see it, it's just a lot of the big tech companies where they've gone political, where they've gone woke, they go rogue. PayPal looks as if it's all over for that company, because they've done such a disservice to their clients, and these companies which hold their clients in contempt, their businesses fail, and competition picks up, and plenty of competition for a PayPal, Twitter, CNN, and
we don't want to get too political because I might get shoved off the platform. So
and so Facebook has really taken or given itself an uppercut. So those things are being unwound, but I think the other stuff is progressing very nicely. So conclusions. So gold's taking the next steps in the second leg of the bull market. The underlying demand for gold should be strong for many years, driven out of China, India, and the US and the Middle East as the oil price rises again. Consumer wealth is still growing, and gold rising in all currencies. So the Australian gold sector just looks fabulous. Exploration is running at a very, very high rate. Over $1.5 billion a year. We're going to find a lot more gold. We've found a lot. Gold production.
Still, Barry, there's still a view out there, I guess, in the wider market that it is slightly irrelevant. I mean, I was talking to Rick Rule earlier today, as everybody knows, and Rick's conclusion is that now is a great time because no one's actually that interested. People tend to get very interested when the price starts to move, but actually that's not when you should be looking. I'd love your views on the current, because we've got a lot of companies presenting today, near-term developers coming up to producers, etc., and the explorers. Do you see good value in investing in some of those, the exploration sector in gold, because no one's looking at it?
Oh, look, I just think that the gold sector is just ridiculously cheap. Just ridiculously cheap, full stop. That doesn't matter whether you look at North America or Australia or our big stocks or our little stocks. What's going on in the big stocks, Newcrest, Northern Star, Evolution. I mean, these are extraordinary companies, and they're doing excellent. They're running excellent business models. The sort of second line is that are coming out. Things like Bellevue and Calidus, Ortico, and then we've got people like Silver Lake's buying back its stock. Ramelius has done really, really well, and there are just so many explorers out there who are finding things. And the great part of this particular bull market for the Australian gold sector is that so much money has been raised, which is now being put in the ground. And the problem with every bull market is that the the capital is raised is very, very late in the cycle. And consequently, when prices turn down, the last thing management wants to do is spend money. Well, we're not in that position. We've got a lot of cash, and exploration is underway, and the results just keep coming up.
Well,
and it's not gold, of course, but it's just a very exciting market, and it's not appreciated in the local market, not appreciated internationally.
Barry Dawes, thank you so much for joining us today. You mentioned Calidus, they're coming up next. They're a near-term gold producer, next one out of the block. So it'll be very interesting to hear from Dave Reeves. But for the moment, Barry Dawes, if you want to get in touch with Barry, there are his details on screen now. Make sure you follow him on Twitter at Dawes Points. Font of information. Thank you very much, Barry. Great to see you.
Thanks, Kerry. Have a great conference.